Subbarao, the RBI president, who is holding a press conference as we speak. Now, this is, of course, regarding the RBI cuts. The Subbarao holding a press conference on the same. RBI cuts CRR by 25 basis points is, of course, on the basis of which Mr. Subbarao is holding this press conference. The RBI has cut CRR by 25 basis points for this
CRR of scheduled banks by 25 basis points from 4.5% to 4.25% of their net demand and time liabilities (NDTL), effective the fortnight beginning November 3, 2012. The reduction in the CRR will inject around 175 billion rupees of primary liquidity into the banking system. There is no change in the policy interest rate. Accordingly, the repo rate under the liquidity adjustment facility remains at 8%. Consequently, the reverse repo rate under liquidity adjustment facility, determined with a spread of 100 basis points below the repo rate, will continue at 7%. And the marginal standing facility MSF rate, determined with a spread of 100 basis points above the repo rate, will remain at 9%. What's the rationale behind this policy action? Let me explain that. The decision to cut the CRR and keep the policy interest rate unchanged draws from our assessment of the evolving liquidity situation and the growth inflation dynamic. First, on liquidity, systemic liquidity deficit has been high because of several factors: the wedge between deposit and credit growth, the buildup of government's cash balances from mid-September, and the drainage of liquidity on account of festival-related step-up in currency demand. This high systemic deficit will have adverse implications for the flow of credit to productive sectors and for the overall growth of the economy going forward. As regards the growth inflation balance, headline WPI inflation moderated from its peak of 10.9% in April 2010 to an average rate of 7.5% over the period January-August 2012. During this time, growth has slowed and is currently below trend. This slowdown is due to a host of factors, including monetary tightening. Since April this year, the Reserve Bank's monetary policy stance has sought to balance the growth inflation dynamic through calibrated easing. The transmission of these policy impulses through the economy is still underway. In conjunction with the fiscal and other measures recently announced by the government, the Reserve Bank's monetary policy should work towards arresting the loss of growth momentum over the next few months. Yesterday's statement by the Finance Minister, reaffirming commitment to fiscal consolidation, will open up space for monetary policy to restrain inflation and support growth. Now, coming to inflation, it turned up again in September, reflecting the partial pass-through of adjustment of diesel and electricity prices and elevated inflation in non-food manufactured products. It's therefore critical that even as the monetary policy stance shifts towards further addressing growth risks, the objective of containing inflation and anchoring inflation expectations is not de-emphasized. The policy document spells out the three broad contours of a monetary policy stance. These are: first, to manage liquidity to ensure adequate flow of credit to the productive sectors of the economy. Second, to reinforce the positive impact of government policy actions on growth as inflation risks moderate. And third, to maintain an interest rate environment to contain inflation and anchor inflation expectations. As in the past, we've also given guidance for the period forward. By reducing the CRR, the Reserve Bank intends to preempt a prospective tightening of liquidity conditions, thereby keeping liquidity comfortable and supportive of growth. The policy stance anticipates the projected inflation trajectory which indicates a rise in inflation over the next few months before easing in the last quarter of this fiscal year. While there are risks to this trajectory, the baseline scenario suggests a reasonable likelihood of further policy easing in the fourth quarter of this fiscal year. Let me add, though, that this guidance will, however, be conditioned by the evolving growth inflation dynamic. We expect that today's policy actions and the guidance we have given will result in the following three outcomes. First, liquidity conditions will facilitate a turnaround in credit growth to productive sectors so as to support growth. Second, as inflation risks moderate, the growth stimulus of the policy actions announced by the government will be reinforced. And finally, the policy action will anchor medium-term inflation expectations on the basis of a credible commitment to low and stable inflation. As always, our policy action has been based on a careful assessment of the global and domestic macroeconomic situation. Let me comment first on the global economy. Over the last quarter, policymakers around the world have confronted increasingly difficult challenges. Globally, even as the growth momentum has slowed, governments have had to manage the balance between fiscal consolidation and growth stimulus, amidst visible signs that the two objectives are in conflict with each other. As the advanced economies deal with these tensions and global demand conditions weaken, emerging and developing economies are also slowing down. Liquidity infusions by central banks in advanced economies during the quarter have contributed to some stability in global financial markets. It's important to note, though, that liquidity infusions are only a stopgap measure intended to maintain financial stability and arrest further downturn. They cannot substitute for robust structural solutions that can return the advanced economies to the path of recovery. At this stage, growth risks have risen and could well overwhelm the positive effects of enhanced liquidity. Moreover, notwithstanding some muted softening recently, commodity prices are still at elevated levels. Consequently, there is a significant risk of liquidity-driven price increases. Even as the recovery process moves forward, the months ahead will be a period of heightened uncertainty for the global economy. Let me now turn to the domestic macroeconomic situation. Growth decelerated over 4 successive quarters, from 9.2% year-on-year in the fourth quarter of the year before to 5.3% in the fourth quarter of last year. In the first quarter of this year, growth was marginally higher at 5.5%. This slight improvement in the output growth in the first quarter was mainly driven by growth in construction and supported by better than expected growth in agriculture. On the demand side, the growth of gross fixed capital formation decelerated, while a slowdown in growth of private consumption expenditure continued. The external demand conditions and crude oil prices also remained unfavorable, adversely impacting net exports. Over the last quarter, global risks have increased, and domestic risks have become accentuated owing to halted investment demand, moderation in consumption spending, and continued erosion in export competitiveness, accompanied by weakening business and consumer confidence. The industrial outlook remains uncertain. Notwithstanding the improvement in rainfall in the months of August and September, the first advance estimates of the 2012 Kharif production are about 10% lower than last year's production.